Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. It's not every day that a 99-year-old company goes bankrupt, but that's what happened in the trucking business. Yellow Corp, or I'm going to use Yellow Freight. That's how I know this company. Used to cover the stock back in the 80s, back in the day when I was at Payne Weber. YELL is your ticker. Our good friends at Yellow Freight. Tough going at it. Lee Klaskow joins us here. He's a sector head and senior analyst. He covers all the freight, transportation, all the logistics, that supply chain. We blamed it on him in the last couple of years. He's with Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker Studio. So, Lee, Yellow Freight's been out there for literally 99 years. What happened?
Yeah, well, this bankruptcy is decades in the making, at least 25 years when they acquired.
After my time covering.
When they acquired Roadway, I think it was back in 2003. And since then, they just really haven't been able to integrate all these networks that they've acquired. Usually when you do an acquisition, 1 + 1 should at least equal 3. This was 1 + 1 equaled maybe 1.5.
Yep.
And a lot of that had to do with the fact that the company is a Teamster unionized employer, so they were.
Is that unusual in the trucking biz?
Today it is,
okay.
And it's even more unusual now that one of the largest ones is going under.
Okay.
UPS was a Teamster LTL player, and they sold their business to TFI. It was a very highly unprofitable business, very thin margins, and they're competing against companies that don't have work rules, stringent work rules like some unions do, and so they're just able to be more flexible and more nimble. It's not to say that it couldn't become a better trucking company. And again, there's blame to be spread across the board, whether it's management early in 2003 or maybe the fact that some of the things that the union did recently, like threatening to go on strike, kind of accelerated this bankruptcy. Again, 20 plus years in the making.
So is this the case of a union putting itself out of a job?
I don't want to put the blame squarely on the union. I think, like I said, I think there's blame to go around. But the company said that they were going to hold off on a $50 million pension payment, and the union said, well, if you do that, we're going to strike. And then the problem is with an LTL, a less than truckload carrier, it's kind of like a run on the bank. Shippers will move away from you, and then once that happens, you have a deleveraging effect of your network. That means your business becomes less and less profitable, and then as more people move away because they're scared that their freight might be stuck in your system, it just becomes a snowballing effect. And that's why usually when there's bankruptcy in the LTL industry, it's always a liquidation, never a restructuring.
I was going to ask, so there's no ongoing concern. It's not like these truckers are going to still have jobs, just have an executor running the company.
No, there's obviously, I guess there's some good news. Some of these folks are obviously going to rebound. XPO is hiring, FedEx Freight is hiring. There's a lot of other companies that are going to be hiring and looking for people.
But not giving them union jobs and benefits.
No, but the interesting thing, the yellow employees actually make less than the non-union companies just because of
the market.
Yeah. From a pay standpoint, maybe not from an all-in benefit standpoint, from a pay standpoint.
So they make a little less, but maybe they have higher benefits and air conditioning in the cab.
Right.
That was one of the shocking things to me about the UPS. And
ever
since then, I've been looking at UPS delivery guys all over the place, and they are sweating bullets.
Yeah. It's a hot job.
They work hard. All right, let's step back and take a look at the trucking business in the United States. Kind of where are we these days? Again, we came through the pandemic. There were definitely some supply chain issues that just went all the way back. It from the ships until it gets to the warehouse. How that works. Talk to us about how the trucking industry is these days.
Yeah, so there's two types of trucking that I look at. I look at the truckload industry, and those are companies like Knight Swift, Schneider. You probably see all those trucks on the road. Then you have the LTL carriers, the Yellow, XPO, Saia. FedEx Freight, ArcBest.
LTL, by the way, just sorry to interrupt because I don't know as much about this as you guys do. LTL just means they're going to go and pick up your load and truck only your load, even if it doesn't fill up their hauler.
Right. It's usually, how most of the LTL carriers like it.
Which is less than truckload.
Less than truckload.
Yeah.
Sorry. Yes, less than truckload. They like it on pallets, so you can get a forklift in, pull it out, and then go across the dock, put it in another truck, and then keep on doing that. In the olden days, I actually, a long time ago, I worked at an LTL carrier unloading and loading trucks in the summer. Graveyard shift, hardest job I ever had in my life. This job's a little easier. And that was very hot as well. And nothing was palletized. You had to take everything off the truck. Some of yellow stuff, a lot of the yellow freight, not to keep on going back to yellow, because a lot of the carriers that are going to be left, they're going to be going after some of this business, but not all of this business is good freight. Some of it is not palletized, so it's more expensive to move. A lot of it might have high cargo claims, so it could be glass, it could be TVs, things that tend to break when you move them around. So they have about 6.8% of the shipments in the U.S. XPO, FedEx Freight, the other ones, they're not going to want all 6.8% of that. So it's going to be interesting to see where that kind of the not so great freight ends up going. But it'll be a real great opportunity for the carriers that are left, because they're going to probably have good freight at good rates at good margin, and it should be really good incremental margins for the LTL carriers.
In trucker lingo, could you explain to Matt what reefer means?
I know what reefer means.
No, for the trucking industry, it has a specific.
It's different.
It's temperature controlled, so food, pharmaceuticals,
refrigerated truck. I just wanted to get that out.
A
there
reefer
for you.
truck. I get.
Yes.
All right. So Lee, your company's
It's not the same as the one in Cheech and Chong, Up in Smoke.
Yeah.
or at the fish show the fish shows that you
Or at
tend to
the
go to.
fish show.
So, all right, Lee, your companies, the truckers, the railroads, the global ocean shippers. I can't think of an industry that's got a better look on the economy than those types of companies. What are those companies saying about their economic outlook?
Yeah, so I think we actually just spoke to one of our companies this morning. We spoke with DHL, and they were telling us that they're not expecting much of a peak season this year.
Really?
And if they do see it, they'll probably see it in the air freight on their forwarding business versus their ocean business. A lot of the other carriers like Knight Swift, they're all talking about you're seeing the destocking happen. But
So destocking, that's just retailers just bringing down their inventories.
Exactly. Okay. And they're not seeing the restocking
okay.
where they're filling up the inventories. So we're at a situation where the consumer is obviously pretty resilient, but we're just not seeing the normal seasonal patterns yet. We're pretty optimistic. I guess we're probably a little more bullish. We think we're going to see not a peak season, but we are going to see an incremental increase in demand. And that's going to have a really positive impact on the truckload industry. We've been calling a bottom for that industry for quite some time on the rate side, and so far it's been playing out. We think that as we go into the fourth quarter, they're going to slowly increase. Now, a lot of the trucking companies that we cover, they don't play in the spot market, but it's kind of like this. It tells you where contract rates are going to be 6 to 9 months out. And so what we're looking closely at the spot market, we look at it every week, try to figure out where it's going. We think that's going to set up next year pretty good for the truckload industry for contracts. This year, contract rates are down anywhere between mid to high single digits. Some companies are even seeing them down low double digits. But they can't come down much more because they've had all the inflationary pressures that every other company has. They're paying their people more, equipment costs more, insurance costs more. So eventually the larger companies are just going to say, we'd rather not take your freight because it just doesn't make sense for us.
How about if I own a truck and it's parked in my backyard, a big, 18-wheeler, can I get business anytime I want? Can I work anytime I want?
You
Is
can't.
there that kind of demand?
You can because there's an app for that.
Oh.
Everyone and their mother has an app. Every large trucking company has an app. You have the Uber Freights of the world. You have load boards like Truck Stop or DAT. So all you need is a smartphone and a truck and a CDL, and you can move freight. The problem is you might be moving freight at a loss, and that's what a lot of truckers are dealing with now. So as time goes on, some of the truckers, or we'll call them high cost truckers that are kind of came into the market at the peak, and their equipment's more expensive and their insurance is more expensive, and they thought they were going to get these great rates that they were getting during the pandemic. Now that rates are down considerably, 20 some odd % from last year, they're not making money, and eventually you can only operate for cash flow for so long until you're just like, I'm going to go do something else. And a lot of truckers, the owner operators come in and out of this business. They might work, they might drive their truck as a long haul trucker, or they might do construction, or they might work in warehousing. So it's.
And my neighbor in North Carolina had his 18-wheeler parked, beautiful truck, parked next to his little house in Durham, North Carolina. He's like, I feel like working for the next 3 or 4 weeks, and he'd just go out and do it. So I don't know if that's
my dream, Paul. That's my dream, as you know.
Exactly. All right, Lee Klaskow, thanks so much for joining us. Lee does all the transportation stuff.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Matt Miller, Paul Sweeney here in the Bloomberg Interactive Brokers studio. All right, we got the S&P up. Let's call it 18% year to date. The tech-heavy NASDAQ is up over 30%. I mean, the back half of August and September are some of the best times of the Jersey Shore. I think I'm just packing it in. I'm done. And I'm just going to go down the shore because I've got a great first half. I don't need to do any more. But let's see what the professionals are out there doing. David Katz, president and CIO at Matrix Asset Management, or Advisors, Matrix Asset Advisors. David, I mean, boy, that's a heck of a first 7 months here in this market. Is there anything left in this market?
We do think there's still a batch more left, but we think that it's going to come from different places. If you look at the first 5 months of the year, the largest 7 technology companies were up over 65%. The rest of the market was flat. Since that time, the broader market's been doing better. There's been a lot of catch up. We think when you look for the balance of the year, you're going to continue to have catch up with things that have not done as well in the first 7 months of the year. We think they will start to rally. And we think the things that did great can still do okay. But we would agree with you, there's not going to be a repeat of that.
So are you not concerned that we're going to have a recession? We just talked to Bloomberg Economics' Anna Wong. She says October is now her prediction for the beginning, and she says it's going to start slow and then get really steep.
Well, we don't think it's going to be steep. We think that it's even money whether we have a short, shallow, modest recession or a soft landing. We think the economy has been unbelievably resilient, but you have to offset that with the fact that the Fed has been increasing rates for the last year and a half. We think that the Fed is close to an end, but a lot of the things that they did have lagging impact. So we think you could have a modest recession, but we think a modest recession or a soft landing would be bullish for stocks. Deep recession, which we don't expect, would be bearish for stocks.
All right, so I'm just looking at some of your picks. Because it's interesting, because again, we've talked about it before. A lot of the big cap tech names have really led the market here. If I wanted to broaden it out, Medtronic is one of your names, a healthcare device company. Talk to us about Medtronic.
So healthcare did very well on a relative basis in 2022 and has been miserable in 2023. Again, we think there's going to be a rotation and catch up. In terms of Medtronic, the procedures for cardiovascular are finally starting to get better. You had United Healthcare say that more people are going to the hospitals for these procedures. Medtronic has had a number of disappointing quarters. They set the bar particularly low this year. We think this quarter, for the first time in the last 4 to 6, they're going to have good numbers, and there's a reasonable chance that they beat and can raise expectations. You're getting it at a pretty reasonable price and a very nice dividend yield. We think if you have a 12-month time horizon, you easily have 20 to 25% on the upside.
Why do you think these stocks haven't done better, though?
Well, again, certain stocks did well last year, and there was a rotation. The things that did well last year have slowed down this year, and vice versa. Financials also did particularly poorly this year. The drug companies had been doing poorly up to last week, and then you had companies like AbbVie, Amgen, that had very good numbers, and the stock really spiked on that. So we think it's going to spread out. So we don't think that you want to question that they haven't done well in terms of, hey, I'm not going to buy them. They haven't done well. And we think you want to look at them as what's going to be the next thing that rallies. And we think a lot of those drug companies and med tech companies are going to start to do better because their fundamentals are strong, but the stock prices haven't moved yet.
Hey, David, I can't remember the last time on this show we ever talked about it, electric power company, utility company, but you've got American Electric Power, AEP, based in Columbus, Ohio. That's on your list. What's the play on the electric business?
And the stock's down 14% year to date.
Yep.
So that's exactly it. So they're a very well-run company. We like management. They're going to grow the earnings from 5 to 7, 8%. They're going to grow the dividend from 5 to 7, 8%. It's at 15 and a half times earnings. So it's at the lower end of its valuation range. The yield is 4%. So if you go back to your last guest that was looking for a recession, that's the type of business you want to own in an economic slowdown or a recession. And we just think you want to balance your portfolio. We think the economy is going to be okay, but if it's not, AEP is going to be a very good place to be. We think that they haven't done anything. The stock's down. It shouldn't be. So we're not looking for a home run here, but you could get a 4% yield and a 15 to 20% gain over the next 12 months. So again, conservative place, balance out your portfolio.
In Columbus, Ohio.
And in a great place.
Yes.
Yeah. If you need to do channel checks, I'm your man. In terms of screening, I see Air Products and Chemicals as well. So they sell oxygen, which we need,
Sure.
nitrogen, argon, helium, stuff like that. How do you pick these companies, David? How do you screen for these?
So we have 8 valuation models that look at a company's earnings and dividends and return on equity, and we try to value what the business is worth and then buy it at a discount. We also focus on dividends, sustainability of dividends. And in terms of Air Products, they are really consistent earnings grow over time. They've grown the dividend at north of 10 to 12%. The expectation is that that's going to continue. The stock did well last year, has not done a whole lot this year. But we think what's very interesting here is it's a green energy play. But you're not paying too much for it, and you're getting a good yield while you're waiting.
David, how concerned are you about this Federal Reserve? We're going to get a bunch of economic data this week, and if the market seems to be saying maybe one more rate increase or maybe even just hold steady. How concerned are you about our Federal Reserve?
Well, we think the Federal Reserve has overshot in terms of raising rates, so we're a little bit fearful that they continue to do that. You did have one Fed governor say that she thinks there could be additional multiple raises this year. So that's a worry. We don't think they have to. We think inflation is definitely breaking lower. Your last guest just talked about inflation going lower. If you look at this quarter's earnings season, we agree most companies are talking about not having issues with supply anymore, logistics, shipping, all prices coming down. So we think the Federal Reserve doesn't have to increase more. They could do one. It's either one or done or none and done. And if that's the case, and the economy holds in okay, which we think it will, stock should be a pretty good place to be. If we're wrong and the Federal Reserve raises 4 more times, that's problematic. We don't think that happens.
That's a problem for a lot of people there. All right, David, thank you so much. We appreciate it. As always, David Katz, he's the president and chief investment officer at Matrix Asset Advisors. Still bullish on this market even after the run we've had in the S&P, and particularly in the NASDAQ and NASDAQ 100.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to talk Goldman Sachs, Jeff Currie. Do we have Shri? I mean, is he around? I mean,
Yeah,
God
there he
forbid.
is.
I heard he was going to be in studio, and the reason we like to talk to this guy because he is all over the Goldman Sachs beat. So 2 questions about Jeff Currie. He's only one person. He's a commodity strategist. Okay, he's not a key man risk, in my opinion. But high-profile guy. I'd like to know 2 things, neither of which I think we know. A, why did he leave? And B, where's he going?
So, yes, you're right. He's not key man risk, but Jeff Currie is a name that the Bloomberg listeners, the Bloomberg readers certainly know really well. He has been the face of commodities research at Goldman Sachs for nearly 30 years now, and he truly has crafted a brand for himself as one of the most recognizable commodities analysts out there. He makes bold calls. He describes it in an entertaining, in a very easy to understand manner, and he has won his followers. He may not always have been right. Remember, right now he's called for another super cycle in commodities that has not quite panned out. But agree with him or not, everyone in the market will tell you that he is someone you must at least pay attention to. That's Jeff Currie. Of course, there is the broader Goldman Sachs theme that we always wonder about. Another very recognizable name brand leaving Goldman Sachs, the 6th partner in the last couple of weeks. I would argue that It's a little different from the sort of tug of war you've seen in the other parts of Goldman, where there are bigger issues over strategy and some of the reorganizations that they've done that has led to a flow of talent. I can't really attribute that being the chief reason for Jeff Currie in any way that we understand. And look, it doesn't look like he's looking to take any other job immediately. He's going to spend some time with family. He has 2 young kids.
He's only 56 years old.
I was about to say that, but he's still only 56 years old, so it would be hard to bet against a second act.
Here's a quote I like, and is this in? Yeah, it's in your story, Shri. You got it from Colleen Foster, who's like a senior salesperson in commodities, and this is like the best anybody could say about an analyst, i.e., there's never a time I couldn't get a meeting with a CEO, an oil minister, or a hedge fund founder if Jeff Currie was with me. That's the sway this guy had in the world.
He gets you in the door. I actually had a prominent dream about Jeff Currie. Remember?
That's a little disturbing.
Last year?
That is disturbing.
No, we were sitting at a diner, and he was selling me on the commodity super cycle. And he was like, listen, Europe hasn't gone into the recession that we thought it was going to. China's about to come roaring back, and U.S. driving season is going to kick. A lot of that stuff, Europe doesn't look great anymore. China hasn't come roaring back. And the U.S., we're just not using as much gas. There's not as much demand as they thought.
Okay, let's not leave Matt hanging here. Yes, you knew Jeff Currie for his commodities research, and maybe that was something he did on the side. But what was he more famous for, Matt? He helped co-produce a documentary on the British rock band The Kings, trying to bring them back together.
That is pretty cool.
Hey, just stepping away from Goldman, I don't think there's any turnover that we're seeing in Goldman or anywhere else on the street is any different than any past cycles to me. Do you sense that there's anything unusual going on in turnover, or is this just business as usual?
No, I mean, there's certainly a different story at Goldman Sachs. Yes, maybe there's not much in terms of the quantity, in terms of the number of people who are leaving, but the type of people who are leaving. Some of these people who were handpicked for a bigger and greater role at Goldman Sachs, for them to be leaving so soon after they've been on the up. And, Goldman's always had an up or out culture, but the weird part is some of these people were on the up. Either they were kneecapped or they didn't sort of fit in the new plans. They have been getting frustrated and leaving. So it's the type of names that are leaving the building that have caught our attention more than the number of people leaving 200 West Street.
So we have no idea what Currie's going to do then later. Is anyone speculating?
Like I said, I mean, if he seems to have told confidants that for the moment he wants to spend some time with family. But again, if you've been in the game for so long, the itch to get back there will overcome your desire to just relax on the beach. So I will be very surprised if a year later you don't see Jeff Currie pop up somewhere else again.
David Solomon, just characterize kind of the feeling on the street about David Solomon these days. I mean, I would argue that Goldman's doing well, and I would also argue that the foray into commercial banking wasn't his call. That's a Blankfein call. He inherited.
He committed hard, though. Blankfein dated the consumer business, and Solomon married it.
And
is that accurate?
That is accurate.
Okay,
Look,
so he does, in fact, bear...
Look, they had a banking charter after 2008, so it made sense for them to do something as basic as what they were doing, offer some deposits, make out some loans. But then there was this desire to push in and make something bigger, and they will always tell you such a big deal has been made about consumer. It was just 3% of revenues. Yes, it was 3% of revenues, but you racked up losses at a time when you really didn't want those losses, right when the cycle was turning, right when your engines of investment banking and trading were slowing down. You had this. Add that to all of the disagreements people have with his leadership style and how he goes about his business, you create a little bit of environment that feels like there is this air of dissatisfaction that has settled in on Goldman Sachs.
Is that accurate? Because I hear that. Do you think that's fair? I mean, you're right.
I would trust you more than anyone else.
You're right in the thing. I'm just wondering, because it just seems like Goldman Sachs, and again, I've competed against them for 30 plus years, they just win every single year.
And let's get this right. I think when you look at the broader dynamics in global banking, the retreat of European banks, what is happening with Credit Suisse and all of that, what that ultimately does is leave a few very strong players who continue to benefit. And the three biggies that we have, JP Morgan, Morgan Stanley, Goldman Sachs, they have a big, large, growing, deep competitive moat that ensures that they continue to do better in stuff that they're really good at, banking and trading for Goldman Sachs, the investment bank sides for JP Morgan and Morgan Stanley as well, but also the consumer side, the wealth management side at Morgan Stanley. They are certainly benefiting there. there is this palace intrigue and there is this issue with the CEO and there is this sort of growing noise that you hear out of Goldman Sachs. And one does feel that there's no way that's going to turn around in a minute, even if business recovers. So they'll have to find a solution.
I'm just looking at the stocks. Goldman Sachs, year-to-date, stocks up 3.6%. Morgan Stanley, up 5%. Trailing 12 months, Goldman Sachs up 9%. Morgan Stanley up 8%.
I got a comp chart here. I always pull up my 5-year comp chart.
I know you do.
And Goldman Sachs, over the last 5 years, they're the second best bank of the big six, right? Only Morgan Stanley has done better over the last 5 years.
Well, that hurts because they compete big time.
Right.
I mean,
That hurts a lot, but also remember when we think about the big six, we think about Wells Fargo as the sixth name in that list, right? But they're not a true comp to Goldman Sachs. So I always like to also throw in someone like a Jefferies into the mix.
Okay.
And Jefferies, which is a pure play investment bank,
Yep.
at least right now, has done extraordinarily well in the same time period. So if you add them to the list, they're 3 in the 7. Not bad. Not great. If you're inside Goldman Sachs, you don't like listening to the fact that you're behind Morgan Stanley, but they're getting around to the idea of praising their rival, praising their competitor, and B, hoping to recover that lost ground.
All right, Sri, thanks so much. We appreciate it. As always, Sri and Natarajan.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. I want to bring in our next guest because he traveled all the way from Newport Beach, California. David Bahnsen, CIO of the Bahnsen Group. All right, so David, I got the S&P up, 17, 18%. I got NASDAQ up 32, 33%. I got the NASDAQ 100 up darn near 40%. Are we calling a tech bubble here?
Well,
AI bubble, maybe? I don't know.
Most certainly we're in a tech bubble if you are looking at valuations relative to history.
Okay.
And that premium to historical valuation calls for a mean reversion.
Oh, boy.
And I think that that's inevitably going to happen. Right now, it's interesting. You have Apple and Microsoft below their 50-day moving average, and there are more energy names as a percentage of the index above their 200-day than there are tech names.
Interesting. Well, we got WTI crude oil at $82. It's had a nice run off of that 67 low from 4 or 5 weeks ago. So where are you looking at? Where are you talking to your clients about where they should be looking for some opportunities here?
Well, it's funny, as I was listening to you guys talk about McDonald's, I was thinking not about the quarter pounder or the calories, but the 67,000% return it has had since 1967. That's a real number. Compounded, reinvesting those dividends, McDonald's is the best real estate company that happens to sell.
Which I didn't know that until I watched the movie. Now I got it.
We've owned it for many, many years, and it's interesting. We bought it in the financial crisis at 50. It's now at 300.
Wow.
And the dividend has increased 6 times, just as the stock has gone up 6 times.
How important are dividends to you, just in general?
It's what we do.
It's what you do.
And it's not just dividends, it's the growth of dividends. So that's why I use McDonald's as an example. But I can't think of a better environment than the one we're in right now, where the growth of the income is more important while you also get better stabilized business models. People are too dependent on AI, too dependent on momentum, too dependent on multiple expansion. They're the most vulnerable right now.
So it's interesting. I was talking to somebody, an investor yesterday, large cap growth guy, and he said, we were talking about Goldman Sachs and the other big public investment banks. He doesn't want to buy them because they still pay their people as if they were a partnership, right? Every time they have a bad year, they say, we got to pay these guys because they're the talent and it's the most important thing. When they have a good year, they're like, we have to pay these guys because they're the talent, that's the most important thing. And they never give money back to the shareholders, or not as much as they should for a public company. Do you agree?
Well, see, I have a name for him that is the exact same business, but a totally different outcome. It's a little investment bank called Moelis.
Yeah.
The ticker's MC, where all they do is Ken Moelis was old vice chair at UBS, started this investment bank. They give
Banker DLJ back in the day.
100% of free cash flow goes back to shareholders as dividends. And that's all they are as a deal company. Unlike Goldman Sachs, which is a balance sheet company to some degree. They have to maintain capital for especially that fixed income trading. Moelis, more pure advisory. So that's what we're really into. Look, we own Blackstone and Apollo. All we are is getting a piece of the management fees that they're charging. And clients don't seem to mind paying it. The results haven't done anything to keep people from paying it. And so when you own those companies, it's not balance sheet risk. Yes, they pay their people well, but it's very performance driven. I think Wall Street's one of the few meritocratic areas left, to be honest. I see that as a good thing.
Well, one of the things that Goldman Sachs, that David Solomon is doing right now, he's selling, their big balance sheet business, the investments they've made in real estate over years because the returns have been volatile. But I was just talking to Sri Natarajan about this. He said 1 year they'll make $6 billion on those investments. Next year they'll lose $1 billion. The next year they'll lose $2 billion. But then they'll make $6 billion again. So over 4 years, they've made net positive $9 billion. But since investors are so worried about quarterly or annual reports, they don't care about the longer term picture.
Well, I am a good investor then because I couldn't care less about quarterly smoothness of those things. But with balance sheet businesses, it's not just that it's going to be volatile. You're going to evaporate capital at times. You're going to take on big losses. Dodd-Frank took away their ability to do much of that. But see, that's not just a good thing because there's less risk. It's a bad thing because there's less upside. Morgan Stanley remedied it by becoming more of a fee-based wealth management business. But we believe that these Blackstones, Apollos, Owl Rock, they're able to take huge fees around being an asset manager in a space that has huge growth in front of it.
So, David, the importance of dividends to you and your firm and your investment outlook. If I got you in a room with Tim Cook at Apple, what would you say to him?
I would be very respectful because how could you not be with someone who's created that kind of wealth? And then I would simply point out that the day and age of them saying we can do better with your money is long gone, that there must be a greater return of capital to shareholders, that they have proven that for years by holding on to hundreds of billions of dollars. If they had found better opportunities to deploy it, they would have deployed it. And so by keeping a yield somewhere around 0.5 percentage point, I think it is a very, very good opportunity for them to increase return on equity by paying more back to shareholders. In the meantime, they have abundant resources to still go do R&D and consumer product expansion.
The great thing to do is find stocks that are misunderstood by the market, right? And Simon Property Group is one you like. When I looked at that, my instant, my brain said, oops, commercial real estate, that must be a bad thing. You think a lot of people make that mistake?
I think a lot of people do. And Simon Property is a great example. It was at $50 during COVID. People said no one's ever going to the mall again. Now it's at $125, and people don't realize they have a higher occupancy rate now than they've ever had in the history of the company. Basically, about 95% of their square footage across 287 high-end malls is occupied. They bought JCPenney basically for free and are now selling the old JCPenney buildings.
Is that right? I didn't know that. I forgot about that. Okay.
They paid something like $500,000 a box when they were selling for $20 million a box. And they are selling them to Amazon to be fulfillment warehouses. They're repurposing them into hotels and more entertainment-oriented malls. Simon Property has a ton of unleashed value that will get developed over time. And while you wait, you're getting a 6 to 7% dividend yield that's coming straight from net operating income. And they just have a very well-run balance sheet, about 47% debt to value. It's really low. And to the extent they've had about 5 malls that have done poorly out of 287, those were non-recourse. They gave them back, and the CMBS people had to fight over the assets.
I wonder what one of your books, or your most recent book, I guess. There's no free lunch. 250 economic truths. Yeah. Love the title. I was hanging out with Gary Schilling, as I was telling these guys yesterday, and he said that's his one main takeaway. There's no free lunch. What do you think about these $1 trillion deficits that we're running? What do you think about the magic money tree that everybody seems to have bought into in government? Does that ever catch up to us?
Well, it does, and the question is how it catches up. And so Japan's been at about 230% debt to GDP, and what it's done there is basically 30 years of no economic growth. So we're now at 15 years of 1.6 economic growth. We had 70 years of over 3% economic growth before that. So the cost so far seems to be a downward trend on growth, a kind of stagnation in the economy. But do I think that there's a moment in which an apocalypse comes? It's very difficult to predict that. My real quick comment, though, on the $1 trillion deficits is I don't like it when we spend $5 trillion during COVID. I don't like it when there's $2 trillion of spending in the aftermath of financial crisis. But I do understand there's a Keynesian school of thought that believes it's necessary. My problem is during peacetime and during economic expansion time when we're running $1 to $2 trillion deficits. And that seems to be accepted by both sides of the aisle. And the only time anyone fights against it is when the other guy is the president.
That brings it home. Brings it home. David, thanks so much for joining us. You can get back to Newport Beach. You know, they can't be doing work out there. You know, PIMCO people, I think it's all smoke and mirrors.
I don't know, because maybe it's just too warm outside and you have to spend time in your air-conditioned office.
Too perfect outside.
It's 75 degrees there all the time. So
I like that. Yeah,
Exactly.
no, that sounds perfect to me.
All right, David, CIO at the Bahnsen Group. We always appreciate getting a few minutes of his time. I was just saying to our producer, a unique view on investing.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Natalie Wong joins us, real estate reporter with Bloomberg News. Natalie, talk to us about kind of that commercial real estate market. I mean, if I'm a bank and I try to sell off some of these commercial real estate loans I have on my books, am I finding any buyers out there?
Thanks for having me. It's really hard for banks these days to find buyers out there, not because there aren't buyers that might want to snatch up heavily discounted loans, but because the pricing isn't there yet, right? There's a lot of liquidity out there, a lot of dry powder out there for opportunistic buyers and funds that are raised to specifically target distressed opportunities. But the problem is banks aren't ready to meet them at the price that they want to pay yet. The prices haven't necessarily fallen down far enough, although it is starting to. And this is what the story kind of talks about, which is there's been so much pressure building on the commercial real estate market and on the debt market for so long. And finally, we're starting to see that banks are under more pressure to try to sell their loans, to try to add a bit more discount to their deals and find buyers so they can reduce their exposure to some of the riskier properties.
We've heard a similar story with residential, with existing homes, right, Natalie? The people who own them aren't willing to sell them at the discounted price that buyers are looking to pay. In that case, because buyers are having to take a higher mortgage. In the retail market or in the residential market, we call this the Great Reset. That's what they'll call it when it actually happens. What is needed for the Great Reset to happen in commercial property?
It's going to be a years-long process. I mean, sources that we've spoken to, brokers, investors, all say this is kind of like what happened with the malls. And I'm specifically talking about offices because that is the one sector where it's getting hit by borrowing rates and also the fundamental values are falling. It's kind of similar to malls where we've seen that unfold for the past decade, right? And we're still seeing that some of the better retail properties are under high demand. They're selling for good prices, but you have a lot of dead malls and places that kind of still sit empty, and it'll be a process that could be, anywhere from 5 to 10 years. But we're starting to see that it's happening now. And in talking to brokers, they think that maybe heading into the third, the fourth quarter, and next year, we're going to start to see more banks put up loans for sale and, acquiesce to better discounts for potential buyers out there.
So, Natalie, I guess, one of the challenges for both sides of a trade is I don't really know what the underlying value is of commercial real estate in New York. Have we seen any big transactions that we can use to kind of mark to market? Have we seen anything really come to market in New York, for example?
That's the problem, is we haven't necessarily seen a lot of asset sales yet. So it's really hard for people to figure out where the values of certain properties stand right now. We've seen some cases of distress sales, but these are one-off cases. One example that people are really looking at right now is the Signature Bank loans. The FDIC is selling a big chunk of commercial real estate loans. Many of them are in New York, apartments, some offices. And a lot of stakeholders are looking at that to see what the mark to market might be. But the problem is, especially again for offices, people don't necessarily know where office demand and remote work, how that's going to shake out, right? We're starting to see some of the finance firms bring people back to the office 4 days a week, 5 days a week. But at the end of the day, there's still disagreements as to how that's going to shake out and what the overall demand will be a few years from now. And that is how people write down the income for those types of loans and those types of deals. So if you don't know how that's going to shake out, it's really hard to value what those loans will be several years out from now.
What are you seeing, Natalie, in terms of defaults? Because a lot of these lenders are going to be facing that situation, and some of them some of the borrowers are defaulting just to try and renegotiate.
We've seen that defaults have really picked up over the past, I'd say, starting this year. And that's kind of been the next shoe to drop in this whole commercial real estate saga, is that owners, people that are sponsors of this debt are just looking at their property and looking at, whether or not it's even worth trying to throw money in to renovate it or to invest in it long term. And we've seen even the biggest sponsors and owners like Brookfield, like PIMCO, like Blackstone, just walk away from their properties, hand back the keys. And if the biggest investors are doing this, the smaller guys are looking at them and saying, okay, it's appropriate for us to do this right now. We just don't have the money. And that's a big concern for the lenders and the banks, because they didn't write down these loans with the expectation that they're going to take it over and become managers and landlords, right? So for a lot of these guys, they probably want to get ahead of any potential defaults, any potential loan maturities, and maybe sell off the loans at a slight discount instead of having to foreclose and end up having to sell the asset for distressed values down the line.
That's what really surprised me, shocked me actually, to see a company, a firm of the quality and the size of Brookfield walk away from something. I mean, I didn't even think that was even possible. I mean, from how do I walk away from JP Morgan Chase where I've got a gajillions of dollars worth of deals I'm doing with these guys every year? But that's what happened.
Yeah, I mean, it's simple economics for a lot of these bigger folks. They have distressed funds, actually. They've raised distressed funds to target opportunities across real estate as well for this particular cycle. And, for them, it's a lot of these loans are non-recourse, meaning they can walk away from it and the lender can't go after their other properties. So it's easy for them to just look at the economics of the building. And if they think that the demand might not come back or it might cost more than it's worth, then it's just simpler to hand the keys back and to refocus their money on something that's a bit more valuable.
Can they repurpose the buildings that they've got? I mean, offices seem to be the real problem here, right? But you're not seeing nearly as much of a problem in malls, surprisingly. We're just talking to an investor who likes Simon Properties, and they've done pretty well.
Right. Offices are the worst performing properties right now. Malls already bottomed out a couple of years ago, so the values have already fallen. Hotels have stayed relatively flat, and we've seen some stress happening in apartments, but that's mostly due to a function of the interest rates, not so much that there's no demand there, right? There's a shortage of housing demand across the country. But with offices, that's really where the glut is. That's really where values have fallen 27% across the US just in the past year, and set to fall more. Yep. And, a lot of people are looking at potential ways to convert properties. But the problem today in the US is that, the regulation isn't there necessarily to allow for zoning in many cities. And it's extremely costly to repurpose a building into residential if you're able to do it due to the structural, standards of the building and whether or not it's even able to convert it.
I mean, I'd always thought about a residential conversion as well, Natalie, especially, the 3rd Avenue corridor here in New York has a lot of office buildings that nobody wants and are impossible to convert into residential unless people all of a sudden are demanding apartments with no windows. I had never thought about converting to self-storage. That might be a great idea for some of these buildings. Yeah. And they haven't fared as poorly either, self-storage spaces.
Some people are exploring that, but that's definitely not happening, on the masses at all because, again, of zoning, right? New York City in particular has very specific zoning about what buildings can be designated for certain uses. And again, self-storage is a very particular type of properties that many of these midtown 1960s to 1980s buildings just might not work out for.
Hey, the 1960s to the 1980s was a pretty good era for me. So I'm just going to leave it at that. Natalie, thanks so much for joining us. Natalie Wong, real estate reporter for Bloomberg News. Yeah, that's going to be a tough conversion there.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.